Chapter 5 is going to discuss cash flows. Cash flows are extremely important to the firm. They are the lifeblood of the firm, you might say. Before we get into the nitty-gritty of Chapter 5, I want to ask one question. Imagine that you have an apartment complex for sale near wherever you're going to school. How much would you pay for that apartment complex? How would you answer that question and determine that value? Well, you need to know the size, timing, and risk of the cash flows. So what you would do is say, if I want to know how much to pay today, let's make it simple and say that this apartment building is going to generate cash flows of $1,000 a year, and they're going to be paid exactly 1 year from today, 2 years from today, so forth, and they go on forever. And let's say that you've determined the interest rate should be 10%. Well, the present value formula will give you the value today because the cash flow started in a year, and it's $1,000 cash flow divided by 10%, which means you'd be willing to pay $10,000 for that apartment building. Well, it's the same principle for any business or firm or whatever. You're not buying an apartment building, you're not buying Caspian Sea Drinks or Coke or Chick-fil-A or any other business. Think of it as you're buying a money machine. So, take what they're actually doing out and just think of it as buying the money machine. So you need to know the size, timing, and risk of the cash flows. Chapter 5 is going to get us started down the road to finding the size of the cash flows. It's not going to do everything we need to value a firm, but it's going to give you an idea of what it means for an angel investor, a venture capitalist, or any investor to look inside the firm and see what's happening. So let me pause it and get a couple of financial statements, and we'll get into the details of Chapter 5. Okay, here is an income statement from 2012, balance sheet from 2011 and 2012. If you look at this, you can see what happened to the cash. Cash was $32,000 in 2011 and $39,000 the following year, so cash went up by $7,000. So that's good, right? Well, I don't know if that's good or bad. I need to know exactly why cash goes up or down on the balance sheet. And I want to divide it up into 3 sections. I know I could have cash flow from operations, I could have cash flow from investing, and I could have cash flow from financing. So when I look at a firm, I want to see not only what their total cash flow is, but I want to see precisely where it's coming from. And you may be able to tell from the sound, or just by looking at the names here, that I want to see positive cash flow from operations. That's the most important. So let's start there. Let's try to find our, let's call them our cash flows from operations. Cash flow from operations. What I do is I start at net income. Look at net income, and that's $3,100. But I know that net income is not really, let me write that a little bit better, net income is not really an actual cash flow, right? Because look at the income statement. Depreciation here is not a cash flow. I just am allowed to deduct depreciation before I come up with my taxable income, so I can pay less taxes. So I need to add depreciation back. So depreciation is going to be $3,700, and I add that back. Then I have a couple other things to look at. I have accounts receivable and inventory. These are both part of the operations of my firm, and I'm going to have accounts payable and accruals. This is part of the day-to-day operations of the firm. So look at it this way. Accounts receivable changed. I want to see the change in accounts receivable. I'll talk about why in just a minute. And it changed by $2,000. I want to know, is that a positive or a negative cash flow? And here's the way to think of it. This sales number, the $60,000 in sales, isn't necessarily cash that goes into your cash register. We just talked in Chapter 4 about trade credit, 210, net 30, and all of that. So if someone shows up and they buy something, but they buy on credit, that may not be cash that comes to you immediately. That would become an accounts receivable, right? So if accounts receivable goes up by $2,000, that means that you've taken on more accounts receivable and you didn't really make sales in cash. So this going up is a negative. And I'll talk a couple more ways about how you can figure that out and how you can think about it. Let's look at inventory, because inventory I think is a relatively easy one to do. Inventory went down by 2,000. Is that a positive or a negative? Well, just imagine any business you want, you have a bunch of inventory on the floor, or you're a car dealership or furniture store, you have a bunch of inventory out there. Last year you had $29,000 worth of inventory. Today you have $27,000 worth. You must have sold inventory off. So this is a positive. If inventory numbers had increased, you must have bought that, which would be a negative cash flow. Let's look at accounts payable. Once again, the delta for change in accounts payable and the change in accruals, which will be the same thought process. So accounts payable goes down by $4,000. Is that good or bad? Is that, and I shouldn't say good or bad, is that positive or negative for the cash flow? And the answer is it's negative, because accounts payable is money that I owe. Well, I owed $37,000 last year, $33,000 this year. I must have paid off $4,000. So that's a negative cash flow. Accruals, for our purposes, I want you to think of them this way. Accruals are salary that's owed, or it could be something similar to that that's owed. So I owed $11,000 last year, I owe $12,000 this year. I effectively borrowed $1,000. So that's a positive cash flow. So I add all of those up, and my operating cash flow is $3,800. This means, from a business standpoint, if I'm evaluating this business, this is good. The operations of the firm here are actually generating cash flows. So that makes me happy. Now let's look at cash flows from investing. So let me do this in a different color so we can kind of keep everything straight here. So if I want to do cash flows from investing, well, that's two different sources, and we're only going to deal with one. One source, for example, Microsoft owns shares in Yahoo. Well, if those share prices go up or down, if they sell those, that's positive or negative cash flow from investing. So if you have a firm that buys or makes an investment in another firm, that would be cash flow from investing. We're not going to deal with that. We're going to deal with plant, property, and equipment. We're going to deal with fixed assets. So did they buy or sell plant, property, and equipment? Well, I look and I see net fixed assets on my balance sheet, but I really need gross fixed assets, because what I want to look at, gross fixed assets, remember, are my assets recorded at their purchase price. Well, I'm not required by law to put that on my balance sheet. All I have to do is put net fixed. So we know that gross fixed assets minus accumulated depreciation is equal to net fixed assets. So I need to know the change in gross. How can I do that? So here's 2011, here's 2012. Let's think about what I know. I know the net fixed assets in 2011 are 90,000, and I know in 2012 they're 92,000. Okay, I don't know accumulated depreciation from 2011. Let's just say it was, pick a number, $10,000. If that were true, that would mean that I have accumulated depreciation over the life of the firm of $10,000, and my gross fixed assets would be $100,000. Alright, what I do is I take the depreciation expense off the income statement and put it into the accumulated depreciation portion of the balance sheet. So $3,700 this year, that means the new accumulated depreciation is $13,700. Right? So this is the accumulated depreciation, means every year I take depreciation expense and put it into that bucket, if you will. It was $10,000 last year, so now it's $13,700. This means this is $105,700. So the change here is $5,700. It went up $5,700. That means I bought stuff. So this, I think, is probably good news. I can't tell completely, but they're buying things. They're buying plant, property, and equipment. That's a good sign. If they were selling plant, property, and equipment, that would probably be a bad sign, that they were in some type of financial distress and selling things off. So as a financial analyst, I'll look at this $3,800 in cash flow from operations and say positive, that's good. Cash flow from investing, I'm not really sure exactly. I'm going to need a little more thought into that. Just trying to give you an idea of why this stuff is important. So that's my cash flow from investing. Let's look at my cash flow from financing down here. My cash flow from financing comes from debt or equity, because I either finance my operation by borrowing money, which would be notes payable and long-term debt, or by issuing stock, which would be under common stock. So I need to find the change in notes payable. That is $6,000. Is that a positive or negative cash flow? Well, it went from 48 to 54, which means now I owe more money. If I owe more money, it's because I borrowed more money. So that's a positive cash flow. Then let's look at the long-term debt. Change in long-term debt is up $1,500, so I borrowed more money long-term. Change in common stock. Common stock goes up $2,500, so I issued more common stock. The next thing is dividends, and dividends will always be negative because you will receive, as an investor, receive dividends. As a firm, you're always paying dividends. You can never force your investors to give money back to you, so this will always be a negative number. So how do I come up with that number? Where does it come from? Well, my net income either goes into the retained earnings bucket, because that's earnings I retain, or I pay it out as a dividend, one of the two. My net income was $3,100. So what about my retained earnings? Well, retained earnings increased by $2,000. That means that in the course of 2012, I retained $2,000, right? Because they increased my retained earnings. That means I must have paid out a dividend of $1,100. So this is going to be minus $1,100, and that gives me cash flow from financing of $8,900. I don't really want to see this number positive necessarily. This means in order to maintain my operations and run the firm, I'm borrowing money and I'm issuing new stock. Now look at this, and at the same time they're issuing stock and borrowing money, they're paying dividends. I don't know that all that makes sense. So as a financial analyst, what I want to look at are the cash flow activities from these three sources and see, does it make sense what they're trying to do. For our purposes of our class, we're not going that far. We are just trying to calculate these numbers. Okay, last thing. When I look at all these numbers, the 3,800, the minus 5,700, the positive 8,900, what will those add to? Make sure you realize that's positive. What will those add to? Well, the total change in my cash position was $7,000, right? So I need to add these three numbers up. If they add to $7,000, I can feel sure that I did this correctly. So that's it for chapter 5. Do the three problems, and I think you got it.